It's kind of simple story, right? Chinese government says stimulus, and those kind of more downtrodden consumer-facing Chinese technology companies react, particularly the ADRs. How many phone calls have you had across your desk this week about China and that corner of the market?
Huge. I mean, that's been the main story this week. It's followed on as well, obviously, from the Federal Reserve the previous week. So we've quickly swung attention over to China. And as you said, those ADRs, I mean, we've seen some phenomenal moves. Just take, for example, JD.com, that's up 34% this week, up 9% today. I mean, we've seen some really strong moves, and the market's been, and investors have been keen to pick up on those, especially given the sort of downbeat mood that there had been towards China prior to this week. You know, there's really had been that sense that Beijing wasn't going to get its act together to really pull out that bazooka type sized stimulus that the market was actually looking for. And this week we actually got a sense that perhaps that's actually going to be happening. That's what we've seen. I mean, the big question here, I think now is this a stabilization move, or is this something that we're going to see, you know, the Chinese authorities really support going through the rest of the year?
If you're just joining us here on Bloomberg Technology, our top tech story today is a Bloomberg report that ARM made an approach to Intel that Intel rebuffed, all according to a single source. When you woke up to that news this morning, Fiona, what was your reaction?
Well, I mean, Intel's definitely been in the news, hasn't it, this week? I mean, you know what? This is a stock that's really down in the doldrums. It's really been struggling. It's obviously been approached by several suitors, and this is just the latest. Now, I mean, it all seems a little bit murky and unknown where this might be going. As far as we know, that it's not moving forward yet. But I think, you know, if we consider what's happened to the valuation of Intel, obviously it's down in the dumps right now, and it doesn't really look like the turnaround plan is really going to do the job that it needs to. So that does mean that Intel remains vulnerable.
We're showing a long-term year-to-date chart down 52%. I want to take that step back, Fiona, because it is extraordinary that the icon, one of the icons of chip making, would ever be being discussed as an acquisition or merger target. Intel, of all names, Fiona. How much does that sharpen your investors' minds that this current move of AI is so swift, you've got to be on top of it?
Yeah, that's a really good point. And I mean, you know, if we just think about where Intel was compared to, for example, its peers, you know, it was always the riding high, the strong horseman, and that's no longer the case. And it has been a relatively rapid decline this year, as you pointed out. You know, 50% of its value lost, and at the same time we've seen a huge rally in the valuations of those more AI focused stocks. And so that just really highlights that point that, you know, this AI trade, it's a rapid moving one, and you have to be on the ball with it. And you know what, I think Intel's just lost the edge as far as its tech edge is concerned. It's just losing the ball there, and that really obviously hasn't helped the share price at all.
Fiona, therefore, your clients, do they want single name exposure? Do they want to be stock players in this market, stock pickers, or do they want to go broader? They don't want to have index exposure so they don't get caught out if the wind turns?
Yeah, do you know, we have seen a lot of preference towards index stocks, just for exactly indices, sorry, just for that reason, in order to be able to mitigate risk. There is always that concern of being caught out. Now, obviously, there are some favorites where our traders and our investors are sort of, you know, happy to go into the single stocks. But more broadly speaking, we have seen more of a focus on indices, and that also allows for when we sort of move towards rotations. You know, I think particularly with what's going on with China this week and what we've seen of those concerns in the US previously about sort of, you know, moving towards a potential hard landing in some cases with the weaker than expected jobs data at the start of the summer. You know, that idea that we might see rotation, if you're in an index, that does allow you to benefit from those rotations, potentially out of tech into EM assets, or out of tech into, for example, more defensive stocks if we find that the data goes the wrong way.